So imagine trying to sell a used car. Right.
Yeah.
But before the buyer's bank will even consider cutting the check, they demand this like 6-week environmental soil analysis of your driveway.
Oh, wow. Yeah, that sounds intense.
Right. And a forensic audit of every mechanic receipt you've ever had. And on top of that, an independent appraisal to ensure the upholstery hasn't depreciated past some, arbitrary algorithmic threshold.
It sounds like a total nightmare.
Exactly. But in the commercial real estate world, particularly along Florida's Gulf Coast,
Yeah.
that isn't a joke. I mean, that is just standard operating procedure.
Yeah, it's just how the game is played.
Right. And we are looking at a highly specific, very local dynamic today that completely upends how we typically think about buying and selling property. We're taking a deep dive into the Bradenton and Palmetto markets.
Which is a fascinating area right now.
It really is. And we're working from a rather unconventional source today. It's this no-nonsense guide published by a local real estate investment group called Sell House Fast Cash Bradenton.
What's fascinating here is that this document forces you to look at the mechanics of real estate through an incredibly ruthless, pragmatic lens.
Yeah. Ruthless is the perfect word for it.
It really is. I mean, the guide is specifically targeting local owners, considering a fast commercial property sale. So we are talking retail strips, aging warehouses, office parks.
The unglamorous stuff.
Exactly. And the central thesis here is that the traditional bank-financed way of selling these commercial assets is fundamentally broken.
Broken how exactly?
Well, they argue that in real estate, time isn't just money. Time is an active financial drain. We are going to be dissecting their argument for what they call the direct liquidity play, which essentially, bypasses the traditional market entirely.
Right, and we should clarify for everyone listening right off the bat, we are here to impartially decode the mechanics of this strategy. We aren't endorsing this specific group or telling you to, liquidate your portfolio tomorrow.
Yeah, absolutely not financial advice.
Exactly. We're just unpacking the math and the psychology behind why different types of buyers and sellers value assets the way they do. And as I was reading this guide, the thing that immediately stood out was how it tackles the illusion of a hot market.
Oh, the hot market myth, yes.
Right, because if you look at the Bradenton Area Economic Development Corps data, which the source actually cites, the Gulf Coast is experiencing a massive population surge.
Huge growth, yeah.
So my initial thought was, well, if you own a commercial building in Manatee County right now, selling it should be a breeze, right?
You would think so.
Buyers should be fighting over it, completely bypassing any red tape just to get their hands on the dirt.
Okay, let's unpack this. If the Bradenton market is experiencing such a massive population surge, why are the banks acting so paranoid and slowing everything down?
Yeah, that is the most common and arguably the most dangerous assumption an owner can make. The guide makes a very sharp distinction here. Raw market demand simply does not equal a frictionless transaction.
So demand doesn't mean it's easy. Right, exactly. You would think a booming population means a quick sale, but it actually triggers an intense level of institutional scrutiny.
Interesting.
The gap between a willing buyer and a cleared check is practically a canyon. And that canyon is filled with bank underwriting.
Because the bank isn't buying the location's future, are they?
No, not at all. They are underwriting the building's current risk. When a traditional buyer goes to a commercial lender, that lender initiates what the guide aptly calls a financing nightmare.
A nightmare. Love that phrasing.
It's accurate, though. The bank has to heavily scrutinize the underlying business reality of that specific piece of property. I mean, they aren't just sending an appraiser out with a clipboard.
Like residential, yeah.
Right, it's way deeper. They are forensically auditing every single lease tied to that building. They are tearing apart the rent rolls to ensure the income history is perfectly stable. They are verifying the exact square footage.
And the environmental studies, that part blew my mind.
Oh, yeah, Phase 1 environmental assessments.
They actually go digging in the dirt.
Literally digging. They are actively searching for liabilities buried in the soil. So maybe an old gas tank from 40 years ago or, chemical runoff from an adjacent property.
And it sounds like it takes forever.
It does. A commercial appraisal alone can take up to 6 weeks just to schedule and complete.
Just to schedule it.
Because it requires a specialized expert to synthesize all this data.
So the friction isn't a lack of eager buyers. The friction is the institutional machinery that has to grind through these checks and balances to protect the lender's capital.
Precisely. And while the bank is taking half a year to scrutinize the dirt and the leases, the seller's just left sitting there.
Just waiting.
Right. And the guide makes a compelling case that this delay weaponizes time against the seller.
How so?
While buyers frequently flake out at the last minute because their financing requirements shift, or, the prolonged inspection period suddenly reveals phantom structural issues.
Oh, right. The buyer comes back and says, well, the bank's inspector found a slight sag in the roof joists, so we need to shave $100,000 off the asking price.
Exactly. They use it as leverage.
The buyer uses the bank's paranoia to magically shrink your payout right before closing.
It happens constantly. The red tape creates vulnerability.
So what does this all mean? If the traditional banks are taking 6 to 12 months to clear this red tape, the natural question for anyone listening who might own one of these properties is, well, who cares?
Right. Why not just wait?
Exactly. Why not just wait it out? If you get your asking price eventually, a year isn't that long. But the guide argues that waiting isn't neutral.
No, it's very active.
Waiting is actively draining your equity. They call it the bleeding effect. And it outlines the main risks of holding on to these underperforming buildings.
Because it's not a free ride.
Right. Holding out for a traditional sale is like leaving the meter running on an empty taxi. The vehicle's doing nothing for you, but the bill keeps going up.
That's a great analogy.
Because if you are a local owner waiting on a bank, we really need to examine exactly what is happening to your wallet during that year of purgatory.
And this is where the guide provides a real wake-up call, I think. Business owners routinely hold on to underperforming retail strips on Tamiami Trail or vacant warehouses near the Palmetto Historic District, completely underestimating the holding costs.
They just don't see it adding up.
Exactly. The source identifies 4 distinct financial bleeds that aggressively eat into profit margins while waiting for a traditional buyer.
Okay, let's break those down. What's the first one?
The first is property taxes. As the guide points out, commercial assessments in Manatee County rarely go down.
Right, the county always gets paid.
Even if your building is half empty or struggling to attract tenants, you are paying a premium tax rate just for the privilege of keeping the property on the market.
And then there is the second risk, which is commercial insurance.
Oh, this one is huge right now.
Yeah, if you follow Florida real estate at all, insurance premiums are skyrocketing. But the guide highlights a specific mechanism here. It isn't just that insurance is expensive.
Right, it's punitive.
Exactly. It's that insurance companies actively punish owners of aging or vacant buildings.
Because we have to look at how an underwriter views a vacant property. To an insurance actuary, a vacant warehouse in Palmetto isn't an empty space full of potential.
What is it to them?
It is a massive liability magnet.
Like a disaster waiting to happen.
Totally. Who is there to notice if a pipe bursts on a Friday night?
Nobody.
Right, so by Monday, you have catastrophic water damage. Or who is stopping copper thieves from stripping the electrical wiring?
Which happens a lot.
It does. Because the risk of unmitigated damage is so much higher, the premiums for vacant or underutilized commercial properties are astronomical.
Which feeds perfectly into the third risk they list, which is maintenance and security. You can't just lock the doors of a vacant building and walk away.
You'd lose your insurance if you did.
Right. To satisfy that insurance policy and to keep the property viable for these hypercritical bank appraisals we just talked about, you have to constantly maintain it.
It's a never-ending cycle.
You are paying for security monitoring, landscaping, pest control, and air conditioning just to prevent the asset from physically degrading while it sits waiting for a buyer.
And that brings us to the fourth and arguably the most devastating holding cost.
Let me guess.
Opportunity cost.
Dead equity.
Exactly, dead equity. The guide emphasizes that your capital is trapped. If you have $2 million locked up in a struggling office park, that is $2 million that cannot be reinvested into a higher yield project.
Or a new business venture.
Or simply put into an index fund. To support this, the source actually cites the Florida Realtors Association.
Oh, what they say.
They consistently note that commercial properties sit on the market significantly longer than residential assets. If we connect this to the bigger picture, opportunity cost is the silent killer of wealth. Capital stagnation destroys profit margins faster than bad negotiations.
Because between the Manatee County property taxes, the heavily penalized Florida insurance rates, the mandatory security upkeep, and the invisible cost of what your money could be doing if it were liquid, your actual net profit just shrinks every month you wait for a traditional close.
It really does. And this brings up a fascinating psychological barrier.
Okay.
If the holding costs are so brutal and the bank financing process is a nightmare, Why do business owners endure it?
Why not just drop the price and get out?
Well, the guide attributes this to a phenomenon known as the unicorn buyer.
The unicorn buyer. That sounds very mythical.
Sellers are essentially paralyzed by their own emotional valuation of the property and the persistent hope that a perfect buyer will arrive to save them.
I love how the source tackles this, by the way.
Yeah.
The guide references experts from the Forbes Real Estate Council who constantly warn sellers against this exact sunk cost fallacy.
Yeah, it's a huge trap.
The unicorn buyer is this mythical entity who will cheerfully pay over your asking price, who won't demand a single repair, who doesn't care about the 6-month bank delay, and who shares your exact sentimental attachment to the building.
And spoiler alert,
They do not exist.
they don't exist because commercial buyers are strictly governed by cold math.
Cold math.
And this is where we have to understand how the market actually values an asset. The guide notes that organizations like the CCIM Institute, which is a major commercial real estate network, rely heavily on a metric called net operating income, or NOI.
Alongside local capitalization rates,
Well,
right?
exactly, cap rates.
Wait, let's pause here for the listener who might not calculate cap rates every day, because this is crucial to understanding why the traditional market fails so many sellers.
Yeah.
How exactly does this cold math work mechanically?
It is a strictly mathematical formula that completely detaches the value of the building from the owner's emotional connection to it.
So feelings do not matter.
Not even a little bit. To find the net operating income, you look at how much actual revenue the building generates right now. Today, right? And you subtract the operating expenses. That gives you your NOI. You then divide that NOI by the local capitalization rate.
Which is what exactly?
It's essentially the expected rate of return for that specific market.
Ah, yeah.
And doing that math gives you the bank's valuation of the property.
So to put this in perspective, it's like a bank evaluating a tech startup based purely on the loose change currently sitting in its petty cash drawer, completely ignoring the billion-dollar software it's about to launch next month.
That is an excellent way to frame it, actually.
They only care about the current literal dollars flowing in today.
The buyer isn't buying your building, they're buying the math of your current rent roll.
And the guide outlines a very common, very painful scenario that results from this. It's the bank versus owner dynamic.
A classic battle.
Let's say you own a retail plaza. You've poured your life into it. The location on Tamiami Trail is great, and in your mind, it is worth $2 million.
Naturally.
But the bank's appraiser comes in. They run that cold NOI math based on the fact that you currently have 2 empty storefronts.
Okay.
They deduct for the deferred maintenance on the roof,
Right.
and the bank says, no, based on current income, this is only worth $1.5 million.
Ouch.
The guide is incredibly blunt about this. Who wins that fight?
The bank.
The bank. Always. Because the bank controls the capital. Traditional buyers and their lenders will heavily penalize a seller for the property's current flawed state.
Which creates a massive deadlock. The owner feels insulted by the low valuation and refuses to sell, so they hold on to the property.
Out of pride, almost.
Out of pride. And what happens? The holding costs we discussed earlier, the taxes, the insurance, the maintenance, continue to bleed their equity dry. They're trapped by their own refusal to accept the math of the current rent roll.
Here's where it gets really interesting. If you're listening to this and you've got capital tied up in an aging retail strip or an underperforming warehouse, this is the part where your ears should perk up.
Absolutely.
Because if traditional buyers and banks are so hyper-focused on the current flawed state of the building, penalizing you for every cracked window and every vacant unit, who is actually looking at the underlying potential of the property? Who is looking past that petty cash drawer?
This is the pivotal transition in the strategy. The guide introduces the concept of the local investor.
Okay, the local investor.
Right. A smart, well-capitalized real estate investment group isn't looking at the current struggling rent roll. They are looking at the raw potential of the dirt and the structure.
So they see what it could be.
Exactly. For example, the source mentions that local investors in Palmetto, looking south across the Green Bridge, understand the emerging traffic patterns.
They know the area.
They understand the specific zoning nuances along Manatee Avenue. They are evaluating what the property could become rather than strictly what it is today.
Which leads us directly to the solution this guide is advocating for. Because traditional buyers are entirely bogged down by bank appraisals and that rigid NOI math, the source argues that sellers must undergo a radical mindset shift.
A complete 180.
You have to pivot to buyers who evaluate based on future potential and raw speed. This is the direct liquidity play.
And the direct liquidity play is the mechanism of bypassing the entire traditional bank finance market. It involves selling to off-market cash buyers.
Cash is king, right?
Always. The guide specifically highlights sell house fast Bradenton home buyers, noting that while they are historically known for residential acquisitions, they have heavily penetrated the local commercial sector using the exact same principles of speed and liquidity.
Let's break down the mechanics of this cash play, because it directly neutralizes all the friction we discussed in the first half of this deep dive. How does it practically work?
Well, first is speed.
Right, speed.
Yeah.
These off-market groups close the transaction in under 30 days, as opposed to the 6 to 12 months of the traditional route.
Which stops the bleeding effect immediately.
Exactly. Second, they skip the banks entirely. That means no 6-week environmental studies, no forensic lease audits, and zero risk of the buyer's financing falling through at the 11th hour.
And the third major mechanical advantage is the fee structure. The guide points out in its FAQ section that you are not legally required to use a broker to sell commercial property in Florida.
Wow, really?
Yeah. By going direct to a cash buyer, you bypass the standard 6% commercial broker commission.
That's huge.
On a $2 million property, retaining that 6% represents a massive preservation of capital for the seller.
But the core difference really comes back to how these cash buyers value the property. They don't use the bank's cold NOI formula.
No, they don't care about the petty cash drawer.
Right. They calculate what is called the after-repair value. They are making a pragmatic, immediate cash offer based on facts and local nuances.
Like the property's proximity to the Bradenton Riverwalk or major transit corridors.
Exactly, without needing a bank appraiser to validate their vision.
They are essentially pricing in the risk that the traditional bank refuses to take. The guide cites CoStar Market Analytics to back this up, showing that cash liquidity is becoming the single most critical factor in successful portfolio management today.
It's all about liquidity.
But adopting this strategy requires the owner to completely change their identity in the transaction.
How so?
You have to stop being a sentimental, passive seller waiting for a unicorn and start acting like a corporate liquidator. You have to actively decide that immediate cash and the recapture of your time are more valuable than holding out for a hypothetical maximum dollar valuation that might never actually close.
That is the ultimate trade-off, isn't it? Trading the theoretical maximum price for absolute certainty and speed.
Yeah, certainty has a price.
It's like a strategic corporate liquidation. It's a mindset shift. You stop being a sentimental passive seller and start acting like a liquidator who values immediate cash and time over hypotheticals.
This raises an important question. What is your peace of mind and your time actually worth in a financial transaction?
That's the real question.
The traditional market insists that you should endure months of anxiety, endless property tours, and hemorrhaging holding costs just to extract every theoretical penny from the asset.
And it exhausts people.
It does. This direct liquidity model argues the exact opposite. It argues that stripping away contingencies, avoiding the risk of a deal collapsing, and reclaiming a year of your life has a tangible, massive monetary value.
You're buying your life back, basically.
Exactly. It is the pragmatism of cutting the cord on a struggling asset so you can immediately redeploy that capital into something that actually works for you.
And that is really the core thesis of the entire source material. When you factor in the brutal reality of property taxes, skyrocketing Florida insurance premiums for vacant buildings, continuous maintenance, and the silent killer of opportunity cost.
The bleeding effect.
Right, the bleeding effect, the lower immediate cash offer often nets the seller more actual usable wealth in the long run than the higher traditional offer that takes a year to close.
It is a complete re-education on how to measure profit.
You aren't just measuring the sale price.
No, you are measuring the sale price minus 12 months of financial bleeding.
So to summarize all of this, if you own commercial property in Manatee County, or even if you were just fascinated by the mechanics of how modern markets are adapting to institutional friction, the ultimate lesson here is striking. Speed and liquidity often trump theoretical market value.
Absolutely.
Having a slightly smaller, guaranteed pile of cash today that you can immediately reinvest is a mathematically stronger position than clinging to the promise of a larger pile of cash a year from now that is constantly being eaten away by holding costs.
And as we process all of this, it leaves us with a rather profound macroeconomic thought to consider.
Oh, what's that?
Well, if the true actionable value in commercial real estate is shifting so heavily away from traditional slow bank appraisals and moving toward raw, immediate cash liquidity based on future potential, how might this change the physical landscape of our cities in the next decade? If agility and cash become the absolute dominant forces, will the traditional drawn-out bank financing model eventually become entirely obsolete for local commercial transactions?
That is wild to think about. It really makes you wonder what our commercial districts will look like when speed becomes the ultimate currency and properties change hands in weeks instead of years.
It would change everything.
Going back to our analogy at the start, maybe the days of leaving the used car in the driveway, waiting for a bank to analyze the soil underneath it, are finally over. Maybe the future of the market is just driving it straight to the lot and walking away with your capital.
Just take the cash and go.
Thank you so much for joining us on this deep dive. Keep questioning the status quo of how business is done, keep looking at the underlying math, and we will catch you next time.